Hello everyone, welcome to the fifth of our lecture recaps for ACCA P7 Advanced Audit and Assurance. So, this one was on responsibilities. The first responsibilities we looked at were money laundering. So first of all, what is money laundering? Well, it's an attempt to conceal the true origin or ownership of proceeds that have been gathered illegally to provide control of them and legitimacy. Okay, so it's an attempt to control the true origin or ownership of proceeds which have been gathered illegally to provide control of them and legitimacy. So legislation, there's some legislation covering this. The Financial Action Task Force recommendations were global recommendations and each individual country has implemented them. In the UK they've been implemented through the 1993 Criminal Justice Act, the Terrorism Act, Proceeds of Crime Act, the Money Laundering Regulations and the Serious Organised Crime Police Act 2005. So those have all implemented these recommendations. If you're in a different jurisdiction, then these implementations will be under different legislation. Offences then, what different offences are there under this? Well, concealing and disguising criminal property is the first offence. Criminal property can be property from theft, tax evasion, criminal cartels, maybe bribery and corruption, so that's criminal property. Also, acquiring, using or possession of criminal property, the same criminal property we're talking about before. And also tipping off. As an auditor you have to be careful not to tip off anyone you suspect of money laundering. So that would be making them aware or prejudicing a case. Even a failure to report a suspicion can count as tipping off and is an offence and is prosecutable. So in more detail then, the Money Laundering Regulations 2007, the obligations under this are to put the controls in place relating to money laundering, to appoint a Money Laundering Regulations Officer, to record all transactions and identify all clients, and to report suspicions. Now you'll have to have procedures in place to do this, and you'll have to train your staff as well. The types of businesses this relates to, well, it's anyone involved in investment activities, banking, estate agents, tax practitioners, accountants or solicitors. Basically anyone dealing with financial transactions will have to abide by the money laundering regulations. So the first aspect then, the client identification. The procedures to do this, well, you have to observe the identification as soon as possible. You have to recognise the risk. If the client's not there, you don't just look at the identification without the client being there to look at it as well. If there's no identification provided, you can't undertake the transaction. And remember that if a client is acting for a third party, you still have to get the identification of the third party. Staffing then, well, the main focus on staffing is to make them aware of the regulations. You've then got to provide the training to enable them to undertake the required procedures. With regards to reporting, you've got to have a nominated officer, a Money Laundering Regulations Officer. Any suspicions in the business will go to the Money Laundering Regulations Officer. They will then consider these and decide whether to disclose them or not. If they decide to disclose them, they'll do it in the form of a report. The report's a standard form. It includes the name, etc., the identification that you've seen, the nature of the suspicion, and any other information that's relevant. So policies around money laundering regulations should be all of these things. They should have resources dedicated to them. They should be written so that the procedures are set down and understandable. There should be comprehensive coverage, i.e. they should cover all aspects of the money laundering, and there should be timely resolution to any problems. Management have to support the procedures in place, and the training has to be provided to staff. Lastly, there should be a regular review of the money laundering policies and procedures that you have in place. Okay, so that's the money laundering regulations. What about laws and regulations? Who has responsibility when it comes to the client adhering to laws and regulations? Well, first of all, management are responsible for ensuring compliance with the laws and regulations the business has to adhere to. If there's non-compliance, they have to decide what to do about it, and they should have internal controls in place to make sure that they are abiding by laws and regulations. Auditor responsibilities then are set down under ACCA 250. They have to gather sufficient appropriate evidence that there's been compliance with laws and regulations. They should act with professional skepticism, as we've said before, and they should consider the risk of non-compliance. So how do they consider the risk of non-compliance? Well, procedures to do that: they'll first of all gain a general understanding of the business, they'll understand the industry, and therefore that will let them know what laws and regulations are applicable to that industry. They'll inspect any correspondence, for example with the authorities, to make sure that they're aware of any problems there may be already. And they'll inquire from the directors, but remember, the directors have a vested interest in perhaps not disclosing everything. Again, professional skepticism. Again, then you'll ask for written confirmation from the directors, and we'll look at that in more detail under management representations. So we've carried out our procedures. What may be an indication that there has been non-compliance? Well, the first thing is that there may have been investigation by the authorities which have led to fines and penalties, so you'll maybe look for those. If there are unspecified loans to unspecified parties, this may indicate maybe a bribe or something unregulated. Excessive agency and sales fees, this may be an indication that there's something untoward going on. Purchases at an undervalue, why are you getting something at an undervalue? That would be an indication that, again, laws and regulations may be breached. Cash and untraced payments speak for themselves. Any unusual transactions can arouse suspicion, and again, transactions with tax havens may indicate tax evasion. So what do you do if you discover some of these things? Well, first procedures are to understand the nature of the act, to understand the circumstances under which it's taken place. You then need to evaluate what effect it has had. You'll obviously document all of your evidence and provide a report. So you've got your report. Who do you give it to? Well, your report will first of all go to management. You may then consider reporting to the shareholders if management are involved in non-compliance with laws and regulations, or again to third parties, such as in nature of when the nature of the effect is in the public interest, or if there's legislation which has been breached. You may want to issue a qualified opinion if it has a material effect on the accounts, or if there's a limitation of scope. And last case scenario, you may want to resign your position simply because you've lost the trust you had in management. So those are the various responsibilities under laws and regulations. Whose responsibility is it for fraud and error? Well, this is governed under ACCA 240. ACCA 240 says that the auditors have a responsibility to consider fraud. Remember, error is an unintentional mistake, whereas fraud is done to provide a legal advantage and is an intentional deception. So that's the difference between fraud and error. The auditor's responsibilities then, first of all, they should, if it's immaterial, they should check, but they have no duty to find. If they do find it though, they will have to report it. They have to maintain that professional skepticism throughout and consider the risk of material misstatement due to fraud. If it's a material fraud, well then they have to be responsible for detection because they're responsible for any material misstatements. The directors then, what are their responsibilities? Well, they have to design the controls to prevent fraud and error. Reporting lastly, you've got to report to the management first of all, then to the shareholders, then to third parties, the same as our reporting for non-compliance under ACCA 250. So that was our lecture on the responsibilities of the auditor.